Joining us now, Bernstein senior analyst Tony Sacconaghi and Wedgewood Partners chief investment officer David Rolfe. And I'll start with you, Tony, just on the big picture front here. Now, obviously, tech was really dominated the leadership of this market on the upside, clearly got hurt worse than the S&P 500 last year. What are you projecting in terms of where that leaves the tech industry in the way of valuations? I mean, I know we know the example of what happened after the year 2000. It was a long period before tech resumed a leadership position.
Well, good afternoon, Mike, and thanks for having me on. So when we look at tech valuations today, tech is trading at a 40% premium to the market. Its historical average is a 25% premium. So tech valuations relative to history are elevated. And when we look at growth expectations for tech, the premium growth for tech is actually below its historical averages. So you have tech being a bit more expensive, yet forecasting lower growth. And we do worry about that. You're right. Tech imploded following the bubble from 2000 to 2003. It underperformed significantly. But if we start looking in 2004, valuations for tech were the same level as they are today relative to the market. And tech still underperformed in 7 out of the next 10 years and underperformed throughout the period. And so that clearly is the worry. And it was because the leadership stocks at that time ultimately weren't able to keep growing at the same rate. And I think that is the fundamental question for tech over the next 5-7 years.
Yeah, I mean, certainly you could just look at Microsoft in 2000 at 60 times earnings, eventually went down to 10. Earnings kept growing, but not as fast. Certainly came back, but maybe not all the way. So it's something to keep in mind. And David, I wonder how you go about looking stock by stock, with this in mind. In other words, maybe we can't count on the predominant trade in the market being money flowing into technology platforms. What's key to you right now after this decline we saw last year?
Well, we fish in different ponds than what Tony does. We only own 20 stocks, and Mike, we tend to keep them for a long time. Your point on Microsoft and some of the starting valuations, that on the eve of the tech bubble, really speak to a significant part of the underperformance. But on a stock-by-stock basis, we're finding what we believe are terrific businesses at reasonable valuations, and we like to own what we consider to be the most dominant in their various subsectors within tech or really any other industry, and we tend to invest in them and hold them for a long time, and we're not having a hard time putting money to work in this environment.